With his expertise on the labor economy of America, Thomas Porcelli joins us, chief U.S. economist with RBC Capital Markets. Tom Porcelli, how much of this new inflation is wage inflation, and what does the Fed do about it?
Yeah, so I think here's what I think is really very interesting about this inflation report in particular. I think what we need to keep in mind is those weightings. I think those weightings are going to, these new weightings, I think they're going to haunt inflation for the next few months. You now have a bigger weight on goods. And as we've been writing about for quite some time, the thing that's really doing most of the driving from an inflation perspective is really goods prices. And make no mistake, services are certainly starting the process of amping up here a little bit, but this is really a sort of a goods-dominated inflation backdrop. And what's interesting about that is this new weighting. The weighting is now about 1.5 percentage points more weight toward goods, which again, just keep in mind, this is sort of an interesting thing in the context of we are a service-dominated economy, but goods now have a bigger weight. That's obviously a reflection of what happened last year. Right? People were spending, a lot of this extra money that they had on goods, not services. So I think what's going to wind up happening is, if the transition from goods to services spending, is sort of slower to evolve this year, and we think that probably will be the case, that means that you could actually continue to see some additional upward pressure on inflation because of this new bigger weight on goods. I think that's a really sort of an interesting thing that not a lot of people are talking about. But here's the punchline, Tom, to all of this. While I think that that'll be the case for the next, sort of call it the next couple of months, few months, where you'll see continued upward pressure from goods, I think what's going to wind up happening this year is that this transition is going to happen from people basically spending a lot on goods and shifting to services. And so what will wind up happening, I think, as the year progresses, is that this new firm weight in goods will actually wind up acting as an anchor around the neck of goods prices. So as people shift from goods to services spending, we think that will actually wind up putting some pretty notable downward pressure in the goods space. I want to be clear, that's the anatomy of what we see happening over the balance of the year. Yeah. I think in the immediate term, I do think that you're going to see continued upward pressure. So Tom, I think, and again, it's not to not answer your question directly, but I think that's the thing that's really sort of doing most of the driving from an inflation perspective. The consumer's in a great spot from a wage perspective, to sort of continue to sort of drive spending. I mean, look, we live in a nominal world, whether that's sort of a better or worse idea. And so I think that sort of gives the consumer some confidence to be able to spend. But again, I think that you're going to see this transition away, and I think goods prices could actually start the process of slowing pretty meaningfully. Again, give that a handful of months, but I think that's probably where we're going.
Tom, get me to March, because we need to do March first. Yeah. Middle of March, March 16th, the Fed meets, what's on the table, and what on earth happens with that dot plot?
Yeah, so I think that you're looking at probably four hikes this year. The Fed is going to go 25 to start this process off. I mean, look, again, I love that Powell keeps on saying they want to be humble and they want humility. Look, in all frankness, they should have had that last year, all of last year. I think what they actually need now this year is also a hefty dose of patience, because I think if their patience will be rewarded if they do not get aggressive here early on in the cycle. Inflation is going to start the process of slowing. At a minimum, base effects are going to eat into the year-on-year pace. But if I'm right about this transition from goods to services spending, and that taking quite a bit of the heat off of this sort of the singular component that now has a bigger weight, that's been doing a lot of the driving, I think that if they have a bit of patience, they can avoid a 50. They can avoid going every meeting over the balance of the year. That's for Powell to decide.
Where does the balance sheet come into play here, Tom? Because it's not just about the rate hike mechanism.
Yeah, no, I think that's true. I mean, look, this is, I don't know how much time we have. This is, I'll try to keep this part of it tight. All I'll simply say is QT is not the mirror image of QE. That's not how it works. With QE, the amount of duration that the Fed is pulling out of the market, right? They're buying, X number of 10s or X number of 7s, et cetera. We know that definitively. With QT, you do not know the amount of duration that's being added back into the market, because what happens when the Fed basically starts the process of unwinding unwinding the balance sheet, they create a funding gap between themselves and the Treasury. And so it's the Treasury that decides what duration is going to be added back into the market. So in other words, if the Treasury is going to meet that funding gap with loading up on bills, well, then there's no duration added back into the market. And we think that's actually what they're going to wind up doing, because bills as a relative to total outstanding is actually pretty small.
Hey, Tom, I've got a break to hit, so I've only got a few seconds, but let me just put a conclusion on this with you. Are you saying this gets worse before it gets better?
I don't think there is any question about that. But again, I think you live with it being a little bit worse, because I think by the end of the year, it'll be quite a bit better.